At Palmer Square, we're often asked about our credit market outlook and what we think is going to transpire going forward. We think that an environment for credit continues to be constructive. If you look at it from a macro perspective, the data is pretty encouraging. Earnings are stable to improving. The GDP data is good. Employment is good. Consumer confidence is at record highs. ISM data has been strong. There are a lot of reasons to believe that companies are going to pay back debt, and that's the key. So from a macro perspective, we think that there is going to continue to be a relatively low default rate. From a micro perspective, more bottoms-up perspective, we look a lot at interest coverage ratios. And the reality is that interest coverage ratios are still very healthy. If you look at investment grade rated companies, they're north of 10 times. And if you look at high yield companies, they're north of 4 times. Both are in a zone that gives companies cushion should borrowing costs go up or should EBITDA be hit by a worse economic scenario. So overall, we think that the environment for defaults and for credit is constructive. That being said, default rates, we do believe, will likely go up. They're at really low levels, actually LTM levels of 1.95%. So what you're looking at right now is a situation where certain industries are struggling, certain industries do have problem children, but by and large, we think as default rates go up, it's not a systemic issue. That being said, there are a lot of things that we're watching. We're certainly watching leverage levels. We're certainly watching covenants and documentation. We're certainly watching melting ice cube type companies that are in secular decline. And finally, there's a lot of geopolitical and other things we're watching. So the list of risks is certainly large, but for the Palmer Square approach, which is to maintain a lower beta, higher quality type investment selection, we believe we are really well situated in this environment.